Welcome back. Stocks seeing modest gains so far this year, but with the bull market and valuations we're seeing, is it time to prepare for a correction? Joining me right now is First Trust Advisors Chief Economist Brian Westbury and Fairfax Global CEO and Chief Investment Officer Paul Dietrich. Gentlemen, good to see you.
Good to be
Thanks
with
so
you.
much for joining us. What's your stance in terms of the markets right here? Are we getting stretched on valuations, Paul?
Well, at Fairfax Global Markets, we kind of value the market by, I do a screen every week of finding low PE stocks, high returns on equity, high free cash flow, little or no debt. I'm not finding any companies. And what that's saying is that there are no undervalued companies in this market. Every time that's happened in the past, we've seen a 5 to 10% pullback and correction. I think that would be healthy. I think that would be a buying opportunity.
And you think it's coming this year? I mean, so far, the pushback on that argument is that what's the...
That's a good question, but there's going to be something this summer. And we saw it last year. We saw it the year before. You can have a 10% pullback, and then it comes back in 2 or 3 months.
So you think it's going to be quick, and but it is going to happen and get prices back where they need to be?
And I think it's needed.
What's the backdrop in terms of what's supporting stocks? Brian, give us your sense of the economy.
Well, the thing that's been supporting stocks for the last 6 years is earnings. I mean, and profits have, this hasn't been a PE rally. This has been an earnings rally. And I still think earnings are going to grow. This year they're going to be weaker, but because of energy, if you take out energy, we're up 9 to 10% for the year. Now, the economy did weaken clearly in the first quarter. I think it was a bunch of factors. Oil prices were down, so we stopped drilling as much. West Coast port strikes, the weather. And today's trade data, we had a big surge in the trade deficit to $51 billion for the month. That's going to knock first quarter negative. The second print on first quarter GDP will be negative 0.5%, and that's going to worry people. So I don't know how to predict a correction, but if we do get one, it'll be because of something like that.
Because things have slowed down?
Yeah, absolutely.
Negative GDP. Is that what the market's expecting, by the way? Is that priced in? Negative GDP?
I think people, they have priced it in because the first quarter was an anomaly because of all the things that you said.
Weather.
But that's all changed. All those things the factors that affected GDP in the first quarter. So I'm actually kind of bullish for the GDP going forward.
And me too. This Friday we'll get employment. We expect 280,000. So that's a complete turn.
Yeah.
So we have
a big number.
A negative GDP in the first quarter, but now we're back to 250 plus on job growth for the rest of the year.
But what happens if we don't get that kind of a number? Because remember last month we were all expecting really good numbers on unemployment. It came below estimates. It's not, everyone's expecting very good jobs numbers. If we don't get it, then it really supports Paul's argument in terms of, look, this market may very well correct.
It could. You know, Paul, I don't agree with Paul on the valuation thing. I think the market's still cheap, and we even if interest rates go up from here, a 4% 10-year Treasury is a 25 PE, and the market's a lot cheaper than that. So as you said, where else do you go? And so the place to be, I still think, is equities in the US.
What about the liquidity story? You know, Jamie Dimon wrote this in his annual letter that, you know, the banks are holding all this capital and they're not going to have the wherewithal to provide liquidity if in fact something goes awry. You know, this is one of those moments in time when if we were to see a correction and you sell what you can sell, and if there's not liquidity in fixed income markets, does that exacerbate things?
It could.
Yeah.
It could.
Yeah, and I agree with that. I think Dodd-Frank and all the regulation that we're putting on banks right now have created a less liquid market, there's less depth and breadth to the market because there's just not as much. We have regulated banks to the point where we're creating the conditions for the next crisis by the regulations themselves, and we have to figure this out because the Volcker rule itself is going to cause problems that we can't even anticipate today.
Right, which is the argument that things actually can get a lot worse. What's your take in terms of where the growth is in this economy right now, Brian?
Yeah, I think it's really broad-based, but the key thing that's been driving growth over the last 6 years is technology. I mean, so fracking is really technology. 3D printing, robotics, the cloud, smartphones, tablets, apps. A little app doesn't cost much, but it can change the valuation of a company massively. massively. And that's one of the things that people are missing about this profits recovery that we're in. It's not QE that's driving the economy, it's technology, and technology is driving profits.
I want to find out what that means for both of you and how you're allocating capital. So we'll talk more about that. Gentlemen, stay with me. Brian, Paul, more with you coming up.